All right, good afternoon, and welcome back to Wook Capital Management's weekly Wook in Review broadcast series. This is Rod Alsman, Managing Director at Wook Capital. Just need to read a disclaimer. Want everyone to know I'm recording this as always, and the replay will be available on our YouTube channel. So, just for the purposes of compliance, I want everyone to know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. All right. So a happy early, well, or depending where you're at, beginning of your 3-day weekend if you're an American like I am. We've got markets closed on Monday. I'm going to walk through some of the big ticket items that we included in this week's newsletter, which I have pinned here. The Twitter thread of it. If you would like to receive that in your inbox on Friday mornings, be sure to follow the link in the Wook Capital profile, and you can be added. It's hot, I feel like everyone's talking about AI and NVIDIA, and I hate to talk about the same thing that everyone's talking about, but I think it would be remiss not to spend a few minutes at least talking about it. Just from a format perspective, since we don't have a large audience and I don't have any co-hosts today, I'm just going to go through my prepared material pretty quickly and then kind of open it up. We can talk about whatever that folks are interested in after that, or obviously if they want to talk about the prepared content, that'll work too. So, first things first, we got, I guess the final number wasn't the most impressive number of all time, but it was pretty darn close to it when it comes to how much market cap NVIDIA added, on their earnings this week. It was a little bit shy of $200 billion in market cap. And while in today's markets, we don't often connect those silly things like market cap with the discounted cash flows that they're supposed to represent. The implication is that from the beginning of the day to after the earnings and updated guidance were shared, that the present value of NVIDIA common stock and all of those future cash flows went up by almost $200 billion, which would be larger than all but the top several dozen companies in US markets. So just an astronomically large number. Just trying to conceptualize it, it's really difficult. I mean, the market at this point is saying that AI is going to be a very big thing, that NVIDIA and many others like NVIDIA, Markle, SCMI, maybe just put AI in your ticker and you're going to have a really good time. It certainly feels a lot like it feels like people are not thinking about or doing any sort of real rigorous analytic approach to kind of buying some of these securities, and it's more about buying what is now a very big idea and trend. For example, NVIDIA is, I guess, with today's close, just a little shy of $1 trillion in market cap. And when we think about what it's actually trading at a higher valuation than Cisco did at the peak of the dot-com bubble on a few different metrics on price to sales, price to gross profit. These silly things that don't really, I guess, matter much when the story is that this is going to take over everything. So, I did note on my own personal Twitter at Rod Alsman that I had opened a short position in NVIDIA. I honestly wouldn't be surprised, though, to see the stock make more all-time highs. wouldn't at all surprise me to see it become worth more than $1 trillion, perhaps even $2 trillion. In a bubble, valuations don't matter, and they can go on not mattering until they do, and none of us know when that point will be. Which is not to say, again, just like with Cisco, just like with Sun Microsystems, JavaScript, right, that these technologies are paradigm changing. In my view, AI is a very serious contender to change the world in the coming years. But it gets back to the math is really difficult to understand. If an investor is buying NVIDIA at this level, what kind of forward return they're expecting to see. And I don't think that right now people are thinking about that. It's more a function of sort of some fear of missing out. And when it comes to managed money, as we've kind of talked about in the past during these broadcasts, managed money is compared against other managed money or whatever their benchmark is. And if your benchmark is a major market index like the NASDAQ or the S&P 500, and you are not long NVIDIA or other mega cap tech companies in size, the companies that have done the best year to date, your investors are typically going to be unhappy about your short-term underperformance. And in the world of managed money, as we've talked about in several of our book club series that we hold, we'll actually be holding our next book club series on Tuesday at 8 p.m. We're going to be walking through Peter Lynch's One Up on Wall Street. So folks are welcome to join that conversation. That recording will also be available on our YouTube channel as well as live on Spaces. So 8 o'clock, let me go ahead and actually pin that in here. JP, I see that you joined. I'm going to invite you to co-host if you're able to. But I think we're coming up on this point where managed money that might not have had enough exposure to some of these companies, that they're not really concerned about the long-term returns. I think there's going to be a portion of it that's painting a picture that they have significant exposure to these businesses. And as I've said in the past, that if you're buying what everyone else is buying, you're not going to lose your job for buying NVIDIA, for buying Apple, for buying the other mega caps. So it does seem like there's a lot of that going on. There's also the argument that I am absolutely open to, that many of these big tech companies have fantastic balance sheets, right? Even Apple, net cash balance sheet, even with their debt funded buyback program, they still have a very impressive balance sheet. A lot of the big cap tech companies have meaningful net cash positions. They don't have leverage. They, I think, are a flight to safety play beyond just the chasing the index play. And that's kind of born through from the meaningful underperformance that we've seen in small caps and leveraged players in particular year to date. So strong balance sheets. If you're in technology, you're in the right sector, that's really all you needed so far this year in terms of short-term price movements. Year to date, NASDAQ after today is now up to shy of 31%. The S&P is up less than 10%. The Dow Jones Industrial Average is down a little less than 1%, and the small cap heavy Russell 2000 is up just a touch over 1%. So there's a huge spread year to date that really widened out and has only continued to widen since the bank crisis. And today's winner, right, technology up 2.9%, was year-to-date winner. And today's big loser, energy, down 40 basis points as a sector, is down 9% year-to-date. So, so far it's been a very different story this year than it was last year, pretty much the inverse. But going back to NVIDIA specifically, it really was an impressive result. The markup in terms of expectations versus what analysts had forecast is the primary reason why, right? They had a guidance for the next quarter, for second quarter results, that was something like 40% higher than what the sell side had modeled in. So again, there's a real business reason for the price move, or some of the price move, but it will be interesting to see, how far this AI-driven market rally, FOMO, bubble, rebubble, whatever your adjective for it is. It'll be very interesting to keep monitoring this. Moving on from NVIDIA and the tech discussion, there were several discretionary and staples-oriented companies that have reported, Costco being a good kind of bellwether. The continued message from them seems to be a reduction in consumers' willingness or capacity to spend on big ticket items. So we saw them note that in their commentary. In fact, they target Ulta a lot of them to a lesser extent because of their model, but some of these other retailers have noted upticks in cost from organized crime, from shrinkage. So that's definitely something to keep watching in the retail sector, which is challenged. You've got this consumer shift, this continued shift from goods to services. You've heard me talk on, perhaps if you've listened to some of the past broadcasts, our discussion on what's going on in the freight markets. And we're talking about some of the worst freight markets, depending on which slice we're talking about, since going back even past the great financial crisis. For some truckers, we're talking about the worst ever operating conditions for people who've been in that business for decades. So that on the good side is kind of all being felt through to the end retailer, up through the supply chain. The services side is still remarkably strong, and we continue to see that. I had seen, actually, just to go back to NVIDIA for a second, there's a story in the Journal today, and again, if you're following, I am sharing my screen. I'll try my best not to refer to stuff you can't necessarily see if you're not looking at it. But there was a Journal story yesterday that I thought was an interesting one, kind of going back to the NVIDIA take of, do you want to jump into buying NVIDIA at 30 times forward sales or whatever absurd multiple they're trading at, or are there picks and shovels plays like the ones who are actually producing the chips, TSMC? So the story was talking about TSMC as a potential alternative way if you want to get exposure, which TSMC had its earnings last month, and this is where I heard some contentions from some that you have the people actually producing the chips, TSMC, that are far less bullish than the guidance shared just a few weeks later by NVIDIA this week. So whether so much has changed in the last few weeks in terms of the demand side, or perhaps NVIDIA being a little overly optimistic, or maybe TSMC sandbagging, who knows? But I thought it was interesting, the argument that look for the picks and shovels companies as opposed to necessarily chasing the shiniest of objects. Because TSMC relatively, right, it has its own idiosyncratic considerations. Taiwan geopolitical risk is being one of them, but their forward price to earnings ratio is 16, 17 times, much more reasonable. It's actually around pre-COVID levels from valuation perspective. So I think the point being that you can get exposure to the AI boom bet without necessarily having to pay nosebleed earnings if you look at some stuff that maybe doesn't catch as many headlines. And then alternatively, I think a good way to think about it is, what are the industries that will be severely disrupted by AI, and how can you place a bet accordingly that those business models may be negatively impacted or wiped out? I think it was last week or the week prior, Chegg, the textbook rental company, had called out the impact that they're seeing on their business in a negative way, and certainly not going to be the last one. We I think talked about the real productivity benefits that AI appears to bring for certain various jobs, including customer service. And for example, will those call center businesses, will they be disrupted because AI can be scaled such that far fewer human agents are needed? And if the value of the third-party call center provider is providing that agent capacity, then perhaps they're going to be disintermediated, right? Who knows? I don't know the answers to these things. I'm just throwing ideas out there. So let me continue Going back then to a couple of companies on the Wook watch list beyond what I mentioned about Costco, Dole, which I had made a Wall Street Bets post on Dole a bit less than 2 years ago at this point. The company's only just now getting close to the price level that it was at, which on an absolute basis is not great for a stock to be down almost 10% over a little less than 2 years. Obviously, that's not a good return. Relative to the Russell 2000, it's outperformed meaningfully given how poorly other small caps have done during that time. So, nobody can eat relative performance, but at least some solace for that one. But it is the world's largest fresh produce player, and they, I think, are a good example of some of the stuff that I had pointed out earlier on, that small caps with leverage have just taken it on the absolute chin. So Dole earlier this year moved forward with a plan to sell off a money-losing segment of its business, its fresh vegetables business, which is fresh packed salads and some other products like that. They haven't yet closed on the sale, but they're going to use the proceeds to de-lever. The market has liked that. They, like some other international-oriented companies, had faced headwinds from how strong the U.S. dollar had been last year and the rapid appreciation. So those headwinds, if the dollar cools like it has, turn into tailwinds. So they as well, one other caveat for Dole and many other companies is this annual reconstitution of the Russell indices. So they, among many other companies, are going to be added to the Russell index, which from a fundamental value standpoint doesn't mean anything, but of course from a asset flow and liquidity flow perspective is meaningful. That index funds will need to acquire shares to make sure that it represents whatever percent of the index. So I know that I've seen some different research in the past around index inclusion. It's not 100% clear that index inclusion or elimination can yield alpha from an ongoing basis, but I have seen that it does look like when you're added to the index, that typically at least has a short-term price benefit, and the inverse is true if you're removed. So we've got that going on in about a month. The annual reconstitution is effective after the U.S. market opens on June 26th. So there's about $12 trillion in assets benchmarked against those indices. It's typically a very high volume day. So that's coming up. Dole fits that bill. And yeah, let's see. A couple other topics before I stop yapping and welcome folks to share what they're seeing or come on up and join the convo. Carl Icahn's Icahn Enterprises continues to see just rough waters on the back of the Hindenburg report last month or earlier this month, at the beginning of the month. And stock's down 60% month to date, or over the last month rather. Since the report came out, it's down from touch over $50 per share to touch over $20 per share. And this one is interesting because you have Carl Icahn, who owns the vast majority of the company, getting taken down by famed short seller behind Hindenburg. The dividend yield, we go back to draw the corollary to the bank crisis, bank headache, whatever you want to call it. You had a lot of people pile into certain bank stocks, some of whom are no longer with us, because of things like trailing headline financials and even looking at forecasted financials, which in a crisis scenario, you need to think about preservation above all else. So some people got greedy, tried to bottom feed on things like First Republic and some of these other banks that are gone. Icahn Enterprises, it's got a headline dividend yield now of, if you just Google it, 39%. So I'm sure there are some who are foaming at the mouth. They're licking their chops, whatever you want to call it, when they see that. But I would caution that, if you haven't read the Hindenburg report, it alleges that, effectively it's a bit like a Ponzi scheme, the way Mr. Icahn has this structured. He's obviously denied that. Not to go into all the details, because we know we talked about it before, but the stock just continues to be challenged. There was a good read in Bloomberg, kind of talking about Icahn. We included the link. Even if you don't have a Bloomberg sub, it's in the thread. You're welcome to click that, and you can get a free read of it. But it was a good read, kind of talking about Mr. Icahn and just what's going on with this whole scenario. You've seen Bill Ackman, perhaps, if you follow him on Twitter, enjoying stepping on Mr. Icahn while he's down. They're not the best of friends. But we'll see what happens. This is one to keep watching. We talked about it, I think, last week or 2 weeks ago, that he's got an investigation from the Southern District of New York looking into those Hindenburg allegations. So when it rains, it pours. And it's pretty stormy down in Sunny Isles Beach for Mr. Icahn right now. So last item, well, two last items is, one is debt ceiling. So as of this afternoon, for one, clearly the market is not concerned at all, right? We have as we talked about at the onset, a tech sector that's just melting up right now. You've got yields rising, which these long duration technology companies, all else equal, if yields rise, the value of those future cash flows decline. So it's been pretty incredible, since May kicked off. The 10-year yield has risen from about 3.4 to about 3.8. So yields are up month to date over the last week, and yet it doesn't seem to be impacting these long duration assets. So I'd love to hear if anyone has any thoughts on that one. We've got a Treasury Secretary that said that June 1st, it could be the X date for the country. And we've got a speaker that updated 14 minutes ago. Let's see if we have any more news. The negotiators haven't met in person since Wednesday. They were in regular communication throughout the day Friday. McCarthy, quote, "I thought we made progress yesterday. I want to make progress again today." So we don't have a deal yet. There's been rumors and murmurings of what the deal may look like, reported, but we've still got to actually cross that bridge, and there's not very much time left. So the market so far has completely looked past this, at least the equity market, right? The short-dated treasuries are being impacted. You're seeing very high yields, I think north of 7% in some of these T-bills, which, again, that's an annualized yield. So are you really going to buy and get that much of an excess return by taking on that default risk? We're talking pennies. I mean, depending on the size of your T-bill buy. So yes, those yields look juicy, but for a few weeks, and then what happens if you don't get paid, right? So that's the uncertainty, but that is happening. And obviously, we talked a couple weeks ago about credit default swaps rising. So bond market, the smart money, so to speak, is pricing in this risk a bit more than the dumb money of the equity market, who doesn't give a damn and is utterly unfazed. But we still do not have a deal. It's Friday at 4:30, and while I think there were several prognosticators I saw on various media outlets talking about people not wanting to be positioned negatively in the event that a deal is announced over the long weekend. Still, I have to believe there's a real risk that there is not a deal made, and next week could get ugly in that event. And even if there is a deal, as we talked about, as other people have noted, the Treasury General account needs to be refilled by the issuance of significant numbers of debt securities. when those debt securities are purchased, people need to rebalance. It acts as a removal of liquidity from the system potentially. So that could also lead this rally to potentially reverse. We'll see what happens with that, but still unresolved. And then lastly, mortgage rates. So we're talking about yields having risen month to date, and the 30-year fixed rate mortgage, the most commonly utilized mortgage for American consumers, crossed back over 7% earlier this week. So that's the highest level since before the bank troubles came about in March, and it's a very wide spread against the 10-year. Right, we just said the 10-year's up to about 3.8. So 30-year yields are over 7. That's a very wide spread relative to historical spreads, and it's just still at that level where it's dampening activity, right? Okay, breaking news. Treasury says it won't run out of money until at least June 5th, buying time for debt ceiling talks. So that just came out a minute or two ago. Does not look like the X date will be then June 1st. So they have money through at least June 5th. So I now doubt even more that there is a deal announced over this long weekend, given there's no urgency, so to speak. Okay, so then and that's going on with rates. That's still dampening housing demand. It's just extraordinary how much more expensive it is for a marginal home buyer today than it was a year and a half ago. In the context of how meaningfully those rates have risen, we're talking almost 4% higher. You're borrowing $100,000. That's $4,000 in year one of incremental interest expense. That's 350-ish bucks a month of incremental payment, right? So real impacts on the economy. So let me see here. I didn't know if people were trying to ping me on my personal account, but okay. So that's all that I had for our prepared content for this week's review. Definitely feeling like that FOMO energy is back in the market. Very unfortunate if, like me, you are not all in big tech, and it's been a rough year if you're not long big tech. But someone's got to take one for the team. So if anybody wants to request to speak, it's 4:30. We can run this for as long as people want to have a good conversation over the next half hour or two or so. Otherwise, if not, we can certainly make sure that people get all of their Memorial Day needs satisfied and kick their weekend off early. So, JP, anything you want to add to any of the topics that I was talking about? Or any topics I didn't bring up that you want to bring up?
Yeah. So something I've been thinking about was like, is this something that's similar to what's going on with like what happened with Tesla? Like, obviously the valuation is very different, but it's just completely speculative, and it seems like it just doesn't make sense that NVIDIA is trading at the levels that they are. So, like, how do you compare it with Tesla?
I mean, Tesla did, people posited that there was both short squeezing and gamma squeezing. I haven't looked into NVIDIA options activity, but that was one thing that was remarkable about Tesla and still is how massive of a swathe of the entire options market that one security represents. So with Tesla, you had a modestly high short interest in terms of percent. Bulls at the time probably would call out that it was the highest notationally shorted stock in terms of dollars short. And those items, the influx of new retail market participants buying call options as well as short covering were a couple of the things, as well as, of course, the underlying fundamental shift that they benefited from during COVID, where legacy OEs couldn't and didn't have the necessary chips. They were far better able to produce the vehicles to meet, the huge outsized boost to demand for cars. And I don't know that I would compare them too much. I compare NVIDIA, like, to me, it just reminds me of the .com situation where there's no price that's too high because this is the future and you need to own it. And I think it's very reasonable to make the argument that NVIDIA is going to be a leader for a long time in this space. But again, going back to what's priced in, it's priced that it's going to dominate the space, that massive uptick in cash flows are going to come in a very short order and must come in very short order to justify the valuation, as I kind of see it. So like Cisco, again, it took over a decade for Cisco to get back to the levels it traded at. I'm not saying NVIDIA is going to drop 90%, but if I look at the chart of Cisco systems in late 98 is when it really took off. It went from 1250 in October of 98 to over around $80 by March of 2000. So in 18 months, it went up by 6-7 times, and it's still never gotten back to those levels. And it's a $200 billion company today. It pays a 3% dividend yield. It has an 18 price to earnings ratio. I mean, it's a legitimate business. It's a big business, but it gets back to just kind of, I feel like it's that hype of this new thing that people are just clamoring for, and the most apparent way to play it seemingly is to buy the company who's making designing the chips that are being going to be needed in much higher volumes, which, as I understand it, they are the best and they are the largest and they have a lot of competitive advantages. But I still, I'm sure someone could show me a model that it's going to grow operating income at 40% or whatever, for a decade straight, and that's why it's worth what it is. Just again, if you're investing as a growth investor, you still should at least have some understanding of like what kind of growth you're paying for. And I just see a lot of corollaries here with .com. Yeah, the internet became ubiquitous. AI is probably going to become ubiquitous, but does that mean that you as a equity holder are going to see an attractive return if you buy these AI oriented or related companies at any price? Probably not. So that's what I mean, and I'm certainly open to the notion that I'm wrong. But yeah. I do have to say I took a lot of Schadenfreude satisfaction in seeing that Cathie Wood had sold a massive chunk of her NVIDIA position before all of this move in her ARK fund. Hey, Steve. Nice to see you. Hope you're having a good Friday.
Hey, what's going on? Yeah, thanks. What a week to celebrate to be a AI investor,
Yeah.
So
it's a great one.
So
it's been a great year.
So I think there's something interesting to mention on the NVIDIA. So obviously, I mean we all know the major contribution for the positive sentiment right now is that 4 billion guide delta that they have, which is mostly contributed by the cloud revenue. I think it's interesting because how they handle the conference call as well, because I mean, nobody. If you listen, if you compare to their conference call and AMD conference call, and then the analyst is relatively calm or to whatever the management is saying. I remember when AMD conference call, there were I think one of the analysts was asking about their 50% not gross margin 50%. They were asking for the second half revenue guide, and then they were saying something like, oh, if you're gonna to achieve that target, the guide you were trying to give. So are you implying for like Q2 you need to get like 50% year-over-year growth to get a second half? And then the CEO, Lisa Su, she stumped. She's like, and then the CFO coming is like, you're right. And then the next minute, oh, hold on a second, I got the number wrong because we're talking about half in data center, not year-over-year. And then I was like, I mean, that sounds like a completely different how they trading this two type of conference call. But I think that was interesting. And then in terms the model itself, the valuation. Well, obviously the I get the growth trajectory and everything, but I'm a little I'm not sure to use words confused, but I'm open minded to the valuation here. But I read a different model have been updated. They're all using like exit multiple stuff. I mean, that's exit multiple. We can come up with number, but if we go back to DCF here, so I mean, if we assume right, the bold trajectory. So if we have that type of growth trajectory, say we have a 51% CAGR, 5-year growth rate for the data center itself, and then everything lined up with that single digit, double digit, whatever from the automobile and stuff. We get to a EBIT of like 50 or 50 billion. And then if we use a cash flow growth rate of like straight line it, I mean, it has to be a variable, right? Because it depends on the year. But I can get to
the consensus has 2027 EBIT just shy of 50 at 49 million.
Okay, yeah, something like that. So because I get to
4.5 years out.
I try to match. They're trying to. I know the boat. They're one of the boat cases $20 EPS. I'm in trouble to achieve that number. The best case I can get to is like $16 EPS, and that was like a perfect blue sky scenario. But say we get to that 50 EBIT, and then we get to a free cash flow to the firm around like we do operating OpEx of 20%. We'll get to like 39 free cash flow to firm when discount to present. Maybe like 25-ish billion. And then so if we use a discount rate, I mean, this you can talk about whatever the WACC is. Right now, I mean, we can have obviously we can use a higher WACC, but okay, just benefit out lower interest rate, right? So let's just say we get like 10%, 10.5% WACC, and then we give them like what, like these are all like very high assumption here. So give like 3.5% terminal growth rate. So we will get to a like enterprise value about 500 billion ish if we use that assumptions. So if we do that, and we did a sensitive analysis, the current bull case or whatever we're trading at is we're assuming a WACC of 8% and a terminal growth rate of 4.5, which is, I mean, that's
hard for terminal growth rates to be more than twice the potential GDP. Well, I guess
that's what I'm saying. Like I'm trying to be open minded. Even look like the Cassie Wood, right?
But I think your point is that you need to have massive growth and pencil in a really aggressive terminal rate and pretty low discount rates. And even then, it sounds like what you're telling me is that it's overvalued.
Yeah, I mean, it just I don't really want to use the word overvalue here because it sounds like we're because I know that there's always flaw in traditional DCF, but I'm just saying I'm trying to just be open minded as to like somebody show me a DCF model that matches that realistic expectation. Even like Kathy Wood, like today, she's like, this is a little too much for our appetite as well. I was like, okay, like that's coming from a like exponential growth bull. That's very weird to hear to say, but I think it was interesting. And then just quickly, I think just go back to AMD as well. I think just if we say given a scenario, AI is everything, semi is gonna it's gonna be just blowing out. We're a baby bubble. It's gonna be going to a gigantic bubble, and then we wanna just pour money in, whatever. Then you might want to look into AMD's investor day coming up, because they're going to release a update on the CPU. I think we're looking at June. Was it like next in 2 weeks or so? So that's about and yeah, 2 weeks, like June 13th or so. They're gonna host like event. They're gonna showcase like their data center and AI capabilities. And I don't know if I don't know whatever the narrative is gonna be back when that week happened, but yeah, they're gonna release a CPU. They're gonna give an update on a CPU for the launch of 128 core 5 nanometer, and then there are 3 nanometers CPUs. I mean, they're I would say they're pretty competitive in terms of compared to Intel. Like, because if you look at their market share, while Intel been struggling for the past couple of years, like AMD has definitely been gaining that part of it. Yeah, I mean, NVIDIA is still the dominant holder, like in terms of, like, the market share wise, but just some catalyst to look into if you are very intrigued by the current AI thesis.
Appreciate it, Steve. No, good stuff. Paul, I saw you come up. Chris, Paul, if you want to chime in on NVIDIA or anything else.
I'm just curious, like, Steve, I know DCS are flawed, but why even bother given what's going on?
The cynic in
Yeah,
me kind of agrees with that sentiment. Like, what's the point? We know people aren't really, but I mean, I guess to just understand, like, is there any like scenario in which you could see upside? Yeah,
I mean, that's the thing. Like, what more
right
could
now
you?
from sell side. It's literally EBIT growing from, so it's going to grow 120% next year to 20 billion. And it's going to grow, it's going to CAGR around 30+% through 27, 28. And then, by 2028, EBIT 64 million. So, like, these are huge growth assumptions, which maybe they, hit them, right? And even then, it seems like the implied value would actually be less than, the share price, right? Like, it's
yeah, but you're pricing it as if it has. You're pricing it as if like the execution of that happening is spot on, right? I mean, like, you're pricing in a pull forward that is so fucking massive at scale, which, like, given the recent commentary, like, yeah, okay, like that's a big guide up, but like if you don't hit that, this thing is so fragile. Even this is what happened 2 years ago. This shit is too fragile.
Yeah, Steve, I don't know if you heard Paul's initial question. You're still on mute.
No, I think it's kind of mumble. I didn't get that. What was it?
No, I was just asking, like, I know DCFs are flawed for most things, but it's like, why bother doing it if, especially that, the market environment that not even just NVIDIA is operating in, other things are operating in, can just change on a dime, right?
Yeah, well, the thing is, this type of, so one of the reasons that you see this massive jump in price target is because you have a bunch of sell side start chasing price target again, like what they did with Tesla a couple of years ago. So the
No,
sell side have
forget
their
sell
own.
side. Sell side is irrelevant. The sell side's irrelevant. Why did you do it?
The reason you want to have a model because you want to benchmark whatever their assumption they're trying to come out with. How I look through some sell side model. Most of them they're using exit multiple. So look, it's just a benchmark to give you a realistic assumptions. And then, like I said, traditional DCF is far from perfect. Like this, like even Professor Donald said that there's some different approach to it. So it's not like 100% accurate, obviously, but it at least give you I think the best takeaway if you do a DCF is not really the actual value per share you get, but it's the assumption, the forecast you put it in, and then what's the delta you're getting from the management perspective, from the sell side perspective, and you can get buy side data as well. You just get this delta, and that's how you're generating alpha, because those things really drive the high headlines. Yeah, I mean, price target, you can just come up with a random price target. You can do a sensitive analysis, or you can do it even, you're welcome to do a 5% terminal growth rate if you want. It doesn't matter. So yeah, I think it's just a good source for you to make an informative decision.
And I'm sure that all of the recent buyers of NVIDIA are conducting very thorough data-driven analyses that are informing them that it is a must-buy, just shy of $400. That was very tongue-in-cheek. Chris, nice to see you up on the speaker list. You want to chime in on NVIDIA or take us somewhere else?
Oh yeah, and nice to be here. Thank you for having me. I thought maybe we could do a little segue away from NVIDIA. I was going to ask Paul. He made a tweet about Build-A-Bear, and I've been following Build-A-Bear a little bit, and I'm just wondering, like, he had a call on Build-A-Bear earlier, and I was wondering what was his investment thesis behind BBW.
Yeah. Hold on. Let me actually put it in the nest so you can everybody can just follow along if they wanted to. It's actually pretty simple, and I got wind of Build-A-Bear from this other Twitter guy named Strat. He's a college kid. Actually, just graduated, I think. What was it? But BBW, it's funny because like you don't really think anything of it because of the fact of like it's stuffed teddy bears. Like literally, that's all it is. It's just like stuffed teddy bears. But the thing just spits out cash. I mean, you're looking at like not just like the return on capital from dividends, but also just the free cash flow that it generates. You're looking at it, and you're like, this thing's trading at such a stupid low multiple, even though they have so much going for them. And I think at the time they had no debt at all. They had no debt, high cash balance. They were still growing. They were like releasing new like licensing and IPs and stuff. Yeah, because it was so irrelevant. Like if you want to go back, like look at the chart. If you go back to 2020, I think the entire market cap of the company went all the way down to I think like $19 million. It was like something stupid. And now it obviously is much higher than that. But Build-A-Bear is just really interesting because like, yes, it is a consumer discretionary company. At the root, it's like you're buying a stuffed animal. Like that's what it is. It's not solving the world's healthcare problems. It's not creating, some software tech. It's literally bears. But it's just like the resiliency of people in these bears, man. I mean, like if you click on the link that I put in the nest, you can actually go and take a look at everything that we wrote, which is pretty detailed. And I was like, this thing is trading at such a cheap level, given where it is, what it's doing, and where it's going, that I made the case with Strat, like someone should just go ahead and take this thing private, like literally just take it private. And we included the LBO model in the link, So you can look at it yourself. And we did the math, and it's like the IRR after I think like 5 or 6 years, I can't remember exactly because I'm walking my dog right now. The IRR, if a private equity firm took it private at a 40% premium, I think something stupid high, was still like triple digit returns because this thing is just spitting out so much cash, and it's getting hit because when they released earnings yesterday, they're like, oh, okay, hey, they weren't as good as people wanted. Like the bottom line is taking a hit. But at the end of the day, dude, if you know the narrative of Build-A-Bear, they have so many growth opportunities. And sorry if this truck's like beeping beside me. There's so many growth opportunities that have yet to actually fully materialize. They're just getting started. That the runway for it is still incredibly extreme. And that's kind of why when last year, after we posted our thesis, I think it dropped from like 16 to 13, but then just like rocketed it up to 27, I think it was. And that's because the earnings came out and they're like, hey, yeah, we're teddy bears, but we're still fucking crushing it. So I mean, I'll just pause there because I just threw out a lot.
So
I'm looking.
Oh, go ahead, Chris.
Yeah. Oh, yeah. I'm just looking at the gross margins, and it seems like they really took off in the beginning of 2021, in January of 2021, from 38%, and then they plateaued around like 52%, and they've stayed around that level until now. Do you see that, becoming a new normal, or do you think that's like a COVID sort of, pull forward of, reopening demand that's gonna claw back down?
I think it's a combination of a few things. It's not just like, granted, it's again, it's teddy bears, right? But the reason why gross margin can get very attractive is just because of the channels that they sell their goods in. So it's not just like them selling the one teddy bear at the one store and then you call it a day, right? Like they have different avenues of physical products. They have you can like basically not upgrade. It's like tack on additional items, right? So your AOV per item that comes out, if you built a waterfall for it, you can easily double the price that you're paying for a teddy bear, right? That's if you're getting like clothes and like sounds and a heart and like whatever. Which obviously just helps things in the grand scheme of things. They're also moving towards the technology aspects and the software side of like the licensing IP, movies, branding, etc. So all of that helps. Will it stay there? Sorry, the motorcycle. Will it stay there? I mean, I don't know if that's like the new normal. I'd probably say it's not going to go like crashing down, like a lot of these other retailers are dealing with. But at the same time, they've realized what the problem was with their business, over the last like 7 or so years, especially being over indexed to malls and too high cost of places involved. And they started like moving away towards that. They started doing their vending machines, which I fucking love. Very, very interesting economics of the vending machines. And they're really just diversifying the streams that allow them to squeeze out extra points of margin in a very like strategic way instead of just trying to like put a blanket over space to like kind of get whatever sales they can.
I'm looking now. I have their investor deck up again if anyone's following the visuals, but you've got the traditional, what Paul was referring to, I assume, as kind of mall-based model, and they've got across the spectrum of tourist locations. There's a Walmart model, a concourse model. I guess that's like inside of, I don't know if it's an airport or some sort of
a
facility,
lot of the strategy has been optimizing square footage. So it's not just like, it's not like the old retail model, right? Where you walk into a store, like space is just poorly managed or poorly utilized. Like they've not only reduced store footprints, but they've reduced the square footage of each store, right?
What is the model for those vending machines? Because I've seen a couple of those.
Yeah, I first saw them when I was at JFK.
Those must be crazy profitable. I mean, you're just paying whatever.
No, rent. And it's like it's if you imagine like a snack vending machine, It's literally a snack vending machine, but of stuffed animals. And the logic behind that is like, if you're traveling and you need a quick gift, right? Like what? Like you're not going to go to Hudson News and get them like an "I Love New York" shirt. Like this is stupid. So what you end up doing is you're like, oh wait, teddy bears, and you go there and you just basically pick out a pre-designed teddy bear, and you might get additional accessories for it if you wanted to change it, which are still in the vending machine. And you just pay for it. You get the teddy bear, and then boom, you got a gift. And it's like so easy because it's like what cost do you have to run that? It's just the vending machine. And you just pay for the space. You don't have to pay for employees to monitor it. You don't have to do anything like that. Like if anything, you just have the software to monitor the inventory in it, and then you just send somebody to go get it go refill it up.
You put an NVIDIA AI chip in it, and then it knows exactly what customers will be demanding.
Yeah, exactly. But the best part is, like, I just use the example of an airport because that's where I saw. But the thing is, like, you can use them in like children's hospitals. You can use them in places that it's very high foot traffic, that are like you would want to get the bear as a gift for whatever reason, right? So airport traveling, that's not a gift. Hospitals, someone's sick, hey, I got you a bear, blah, 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 blah. It's like stuff like that. So it's like super, super high margin, low cost of capital. I forget exactly what we put in the post, but I think the payback on it, it's like something stupid high. So it's, I thought it was like, damn, just fucking put these things everywhere. You got a home run just from the vending machines. And actually, that's partially why I was saying that private equity should take it private, because the fact is, like, if you don't have to operate within the lens of the public markets, right? It's not getting it the price that it should be trading at, given the amount of cash that it spits out. Then yeah, private equity takes it private. They just throw a bunch of cash at expansion and execution, because like they'll probably have the connections, blah 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 blah, and like you really put juice to it, right? Like that's true pedal to the metal, like not having to worry about investors like, why are you spending so much on capex? Blah 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 blah. Private equity doesn't deal with that. They just go and do it, which was kind of what I was advocating for. But if anybody is interested in teddy bears, just read that post because it has everything in it. It explains everything.
Very nice. All right, what else is there? What's going on that you guys are hearing and seeing that we hadn't talked about yet? Again, we kind of went through our prepared content. If anyone is in the audience and wants to share any thoughts on anything that's in the thread that's pinned or otherwise, feel free. It's 5 o'clock. Look to keep the call open for as long as we've got an interesting dialogue going on over the next hour. And then we'll wrap.
Did that even answer what you wanted to answer, Chris?
Yeah, I think you did a really good job of explaining. I've followed NVDA. I've just looked at it occasionally, like since 2021, and I saw it had a crazy rally, and I didn't really understand it. So yeah, I think you explained it pretty well.
Yeah, I mean the math is all there too. That's kind of like one of the better posts that I've done, because it actually outlines like, hey, if we actually did take it private, and not like bearing anything against it. We included, all the fees, whatever, blah, 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 the debt, and expensive debt at the time too, right? Because that's when the Fed was still raising rates aggressively, like 75 bips a clip. It still made sense. Like that's how much cash. Stand is loud motorcycles, but that's how much cash this company was like spitting out. So there was just like still a tremendous amount of upside, which also made the case of like, hey, if someone doesn't even want to take it private, then the public market should give it the recognition it deserves, which eventually it did. And then just like everything else retail or consumer related this year, had a nice little pump at the beginning of the year, and now it's kind of like faded.
Yeah, I saw their balance sheet a few months ago, and I really liked the look of it, but I just didn't know how the gross margins would do after this sort of thing. But I mean, the stuff about the vending machines and the e-commerce, right? You can build a bear online. Um, I guess more people are doing that these days.
Yeah, totally. I mean, and like they kind of like capitalize on that really well. So it's good because you look at big picture, management understands where things are headed, and they're not trying to like fight against the grain on that. They're not trying to play catch up. They're actually, I think, um, moving at the appropriate pace that they should, right, strategically. But then they also understand like their bears do, or the animals do sell, especially when they can get like related IP through like the licensing deals, right? So it's not just a teddy bear; it's like a Lord of the Rings teddy bear, right? Or it's like an NFL accessorized teddy bear. It's so like that's really where most of, in my opinion, the value comes from, is being able to do that. And honestly, the companies that they're partnering with have no problem with that, right? You pay them, they get their cut, and you sell more of the bears. I got hit with ads on Instagram for, I think, Lord of the Rings themed Build-A-Bears. So I was like, should I get that just because it's Lord of the Rings? But then I'm like, what am I gonna do with the teddy bear? But it's I think they're appealing very well to the people who would probably most likely buy it, and they're also appealing very well to like the locations of where people would buy it, right? And if you go back to what I mentioned earlier about last minute gifts with airports, hospitals, stuff like that, you're not gonna, you don't want to look like an asshole, right? So it's like, yeah, you have to spend like 40, 50, 60 bucks on a teddy bear to make me look like a great person when I show up. Yeah, I'm probably gonna do that, right? So there comes that like C store level pricing of like convenience factor involved, which also helps.
When is Cedar Grove LBOing Build-A-Bear?
Dude, when I made my case, like before I posted it, I was like, I will literally raise an SPV right now if somebody wants to go in. I was like, we don't need that much money. We can make it work. Um, because I was just, not that it would have happened, right? Because like management still needs to agree to it. But it was just so stupid. I'm like, one of my other another guy who's a portfolio manager reached out to me. He's like, how much realistically would you want someone to chip in if you did that? I was like, oh god, I'm kind of tempted now, but I never actually did it. Mainly because I'm pretty sure the management still would have said no, because like odds are they would have been out of a job, right? But it was a nice little like thought exercise to do.
Well, if you had a bona fide offer and you came, would the board not have to seriously entertain it?
No, they would, right? But it's like, do you really want to go through all of that hassle if you really haven't even started conversations with management of like, hey, I kind of think we should just go private? It's just like you're just kind of like you're getting things together to then fight an uphill battle that you don't even know is actually entertaining, to them. So it's like whatever. I'll just hold the shares and get paid that way.
This company has a very large international exposure? Is that company has like a big exposure in like Asia?
No, it's pretty U.S. domestic.
I think if I'm remember correctly, I think is this company had like a 20% exposure from Asia or something? Is that the same company? They had like what, like 50 million in revenue, right? I mean 500 million.
In revenue?
Yeah, sales.
I think we're talking about different things. Yeah, build. I mean, that's like more than Oh my God, I didn't even check. What's the market cap
Their
that it closed out
total
today?
revenue is a little under 500 last year.
500 million.
Yeah.
Yeah,
Yeah,
I think that's
the
the
market
company.
cap. Go
Yeah, I
ahead.
think they have like 20% sales come from Asia. I think this type of model works well in that type of region because vending machine and this type of toy is pretty popular in Asia.
Yeah, but look at culturally too. I mean, Asian culture and American culture. I mean, they're not
Yeah, I
very
mean,
much the same, but
I'm just saying, like, if you wanna,
gifting it is.
yeah, I'm saying if you wanna like take up value, like I don't know, take probably if you want to take per share, maybe some Asian PE firms will, or some company will be interesting to buy out.
Yeah, but I always hate that cop out. Like, because everyone's just like, because everyone, whenever somebody points to growth, like especially on investor calls, they're always like, yeah, we're going international, we're going to Asia, we're going to Europe, blah blah blah. Blah. Like for the longest time, even still today, everyone still points to growth as in like we got to be in China because China is going to be really important. And then fast forward to now, it's like China's becoming very problematic to do business in. So it's like, yeah, is it nice? Yeah, sure. But also, like, if you're growing internationally, that takes a shit ton of money. It's like, it's not easy to do that, right? But if you're looking at true value, just from the free cash flow that it generates, it's definitely one that you guys should take a look at for yourselves and then decide. One that actually makes sense. It's not pie in the sky ideas.
I guess going back to the question Chris asked about margin, though, because there's a lot of these retail companies who saw big bumps in gross margin since COVID, and I get what you're saying about mix of location, and that makes sense. I'm just wondering how durable some of that expansion is, which isn't to say it's still not a value at these levels. I mean, is that a five? I guess the one analyst who was on it has it at it's at 5 times forward earnings, so it's not very demanding. That's something
Yeah, but
like
think about like what goes
yeah.
into it, right? I mean, like if most if most of the items, right, or the goods that they sell are like fabric based, blah blah blah. Yeah, you're talking about like cotton prices, right, and like being able to control the labor that actually makes, uh, the bearers themselves, or the stitching, or the accessories, or like fucking whatever, right? But I think a lot of that pricing, like, I'm not expecting deflation, but I also don't expect it to like creep up anymore, especially if you're assuming that global demand for those raw materials is going to start slowing down if it hasn't already. Um, like I said, I just don't
But
see
this
them
is, like you
collapsing.
noted, though, this is such a discretionary purchase. So is the willingness to pay just gonna, are people gonna, I guess, not be that price sensitive to these bears, being flattened in price or going up in price when, like you noted, the bill of goods might be actually declining?
But that's the best part because you can still get these bears. You just don't have to pay. Like when I mentioned before about like the waterfall, right? You can start at a bear that's like $30, right? And depending on the accessories and all the bullshit that you add to it, it can almost double in price. But it doesn't necessarily mean you have to. It just has the option to. So you have the people who want to like ball out. You have the people who don't want to ball out. And what I still believe is that they're just not overextending themselves on the inventory front where they're going to be like, oh shit, we're like every other retailer. We gotta start promoting heavy to move shit, right? Um, that's why kind of like even though some big wigs in the name right now that have been kind of being low key activists, but like not anymore because they got what they wanted. We're basically um, they're basically saying that the CEO isn't doing more to return capital. But in reality, she's like, I'm doing it in a very strategic and responsible way. I'm not just going to return capital because you're a fucking hedge fund that wants to make returns. Um, so that's why I don't think she is putting things at risk with
Yeah, their buyback is
making it so that,
about 20% of the current market cap,
yeah, it's
and I
massive.
saw they've
It's
only used a
massive.
couple million of it.
Yeah, it's massive. Um, so that's why I still think she's going to, put things in harm's way when it comes to like hurting the margins? Like, could they go down? Like, yeah, sure. If consumer spending broadly slows down like on goods and everything, yeah, everything's going to go down. I still think they're going to collapse, but they could go down.
I guess I wonder, Paul, because it sounds like with the shift in locations to more maybe stuff that's benefited from this uptick in travel, like I guess that's what I'm curious to see as it plays out is how will they hold
Yeah, but
up as
I
that
don't want to
stuff
put too much
normalizes.
emphasis on that because even though I mentioned like the traveling part does make sense with like the vending machines, it's a very very small
Gotcha.
like project for them, right? It's not like it doesn't make up a meaningful amount of anything right now. Could it? Yeah, absolutely. But does it? No. So I just don't want to put anybody's mind that like the future is vending machines because it's not. It's actually what they're doing right now between the e-commerce and the new strategy behind their retail footprint. Actually, I'm curious if anybody in the room. I mean, it's another small name, but I don't know if anybody has any opinion on Flash, LTCH. If anybody does, I'm all ears.
First time hearing about it.
Yeah, I posted about that one as a special situation in the middle of April. I just been saying that it was yeah, it's a stat, but like whatever. That it was actually trading like well below what it could be liquidated for.
Oh, I know of a SPAC that's trading well below liquidation value. That's running a liquidation sale. Still trading at a deep discount to liquidation value. Sounds familiar.
Yeah, I know. I mean, since then, I mean, the stock has rallied. I mean, like we counted today, it's 30 something percent in like a month and a half. Before this week, though, it was trading at almost 100% from when we went up. But there's been news since then, so I wasn't sure if anybody has followed the name. Wants to sense check anything.
No, but I would not be surprised to see just this be a trend of whether they do it or not, but these fallen SPACs that many of them do have a lot of assets, whether it's just the cash in the books or other, they're way at a
But it's not
discount to
even
what they're
just that.
trading at.
It's not even just that because like what the recent news that came out with them almost kind of implies, and then they kind of it does imply that the company would have to stay public because they announced an M&A deal that's all shares, but the shares don't actually materialize until they reach certain price thresholds in the VWAP. So it's like, how are you going to achieve that? And if the company were to be, liquidated or if it went private, et cetera, right? Like you still need it to function as a public company. Otherwise, you can't really monitor that appropriately or effectively, or even have the liquidity once it actually does reach those targets, if it does. So it got really interesting, which caused that pop the other week.
What other what other interesting ideas are people seeing out there? I know I think you probably, if you follow my personal account, see me comment on British American Tobacco. We're at some extraordinary levels now for BTI, and that's one that's trading very inversely correlated to gilt yields, the UK bonds, which have seen their yields get back past where they've gotten to with the old Trussonomics snafu that happened last year. So that one, it's like at a 15% free cash flow yield now. It's not often you see near $100 billion companies sporting those sorts of yields in this environment.
I just read whenever Devin puts out, which is usually just updates on tobacco.
Yep. BTI to 6.9 forward PE. It's incredible, the spread between them, Philip Morris, and even just the premium Altria trades that to them. It's blowing me away, but maybe the market.
Yeah, it seems like investors are split on whether to keep the listing in London or to move it to New York.
Yeah, I mean, the company's listed in the UK, but it gets the bulk of its profit from the US, plurality of its revenue from the US, plurality of its investors are North American. It's kind of silly that it's domiciled in a downgraded third world country that's an island off of Europe.
Has anyone looked into Kava yet?
What's Kava?
Kava's a new restaurant IPO. It's going to be coming out soon. It's basically Mediterranean bowls. It's if you're not familiar, it's like almost like Sweet Green 2.0.
Are they using AI to put the bowls together?
The food itself is
I'm
AI.
reading it. I'm reading now just a brief write up on it. So okay, they have 263 locations. That's the first I'd ever heard of them. Okay, they bought Zoe's Kitchen. I do know Zoe's Kitchen. I remember that. They had those locations in Miami. Okay, so the S1 came out last week. I see. Yeah, very, very much giving Chipotle vibes. I'm looking at the S1 images. It almost looks like they just lifted it from a Chipotle kitchen.
Yeah, but that's what you have to decide for yourself, right? Is it a next Chipotle or is it a next Sweet Green? Because they also said Sweet Green was gonna be the next Chipotle, and then look what happened with that.
I don't know. I can't touch these because I've thought Chipotle was expensive for its entire existence. So I've just been wrong on these. Wow, Chipotle's forward PE is up to 40, north of 45 times forward earnings. Incredible.
All right, Rod, I gotta go though. Okay,
All right, Paul. Have a nice weekend.
take it easy. Look at Building for everybody. Yeah, you too. Bye.
All right. If anyone wants to look into or bring up any other tickers or subjects, feel free. Otherwise, probably wrap this up at the bottom of the hour. Let folks get their weekend started. Good discussion on Build-A-Bear, though. I mean, there's so many quirky specialty retail names that many just got put out to pasture, at least in the market's eyes, especially during COVID. And yeah, it'd be interesting to see how that plays out for the Build-A-Bear investors.
The retail bankruptcy started in 2019, and then kind of interrupted by the COVID stimulus. So you're just gonna start seeing ice start perking back again. But
yeah, the Big Lots. I don't know if anyone follows Big Lots, ticker BIG, but their earnings this morning. They're another one of those retailers who have been around for decades. They are just getting absolutely slaughtered. The stocks that I don't know how many years it's been. It's you got to go all the way back to the 90s for when the stock last traded at these levels. They cut the dividend today. They are seeing continued issues. They're oriented more toward a lower income consumer, so their consumer is not very healthy. They sell a lot of furniture out of their mix, and that's obviously been a very challenged sector. It's just wild. Some of these retail, the pace at which Bed Bath Beyond failed, right? So retailers that have leverage, if their business deteriorates quickly, they, like Steve said, a lot of bankruptcies likely to come.
yeah, I mean, even the top leaders, like this week you have this company, Ultra Beauty. Like they're supposed to be the leaders in the space, keep making the all-time multiples, and then they even have their earning compression as well. So just look at that chart. It's pretty ugly.
Chris, any other interesting securities you've been pouring over of late?
So I mean, I'm just gonna mention one thing because I have to go. I think just as we started with the AI, I'm zooming in on the AI thing here. I mean, obviously, this is very contingent on the narrative itself, but voluntary economy. So Baidu, we all know that they have their own LLM model, the Aaron natural processing system. They kind of released their press at March, but I think that's something to next that will be a catalyst to watch if for in terms of space. Their cloud revenue for the past quarter was like pretty good. They were like 400% year over year. And then there was a lot of interest in terms of the because the Chinese market, I mean, the Chinese customer behavior is very domestic focused. So if they have something domestically internally launched, then there'll be a big surge in the user base, and then perhaps just some catalyst to watch.
Do you, Steve, think that what are your thoughts, I guess, in summary on where China is at? Because I guess my understanding is thus far their reopening, at least on the consumer side, has been left some to be desired. Do you think that recovery accelerates? Do you think that the state puts some more stimulus out there, or do you have any thoughts on China broadly like that?
I mean, look, the thing is the government's been trying to encouraging spending. Obviously, I mean, it worked a little bit, right? So you like a couple of weeks ago, well, last month, the Macau traffic was very good. People were traveling, people were spending, but the thing is, I think people are reluctant to really putting their capital into their equity market, like I'm talking about financial market, because I think there's a little, I'm not say trust issue, but it's just not as encouraged because the property scares and stuff like that. So there's some sort of you really need some growth in that type of domestic investments, like spending in domestic properties, purchasing, and to really drive that the latter half the customer growth. I mean, their top line retail sales strong, like luxury goods sales is very strong. Like you can see from LVMH, and there's another company called Capri. What's this? Versace. Yeah, they're pretty strong, but the underlying there's a lot of I don't. I'm not gonna dive deep into their in terms of their economic fragility in terms of how the local government bonds stuff like that. That's another topic. But yeah, it's we. Well, I would say we passed that beginning stage of surge in terms euphoria, like returning to customer spending. Now you just have to see if this trend can sustain. So, but I will say if you really want to watch, right? So there is a big sales event coming up next month in I think July. Was it coming up in July? There's a big sales event. Usually one, there's a lot of calendar year sales events in China, like 511. Like you will see their customer spending driving their retail sales. So I think that will be key data to watch. Some online names like JD.com, some maybe even Alibaba or Pinduoduo. Pinduoduo reported earning yesterday. Really decent, I would say. Margin. I mean, they're still investing their domestic sustainable development program, but yeah, you have to watch the data day by day. But I would say initial rush, the easy trade was done. Now the harder part is to pick the alphas if you can really. Obviously, there's geopolitical risk as well, but yeah. So I would say that was just a bigger picture.
Yeah, yeah. I know last week we talked about the Alibaba spins and kind of the breakup, and I'm looking at it. It's at 81 a share. It's at like a 9 and change forward price to earnings, if you believe the earnings, and if you're unconcerned about risks of the Chinese state, then it's kind of like wow. It's not often you can buy a dominant technology platform like that
Yeah,
uh,
but I would
for a
say the
single
best
digit
time to
PE.
yeah, the best time to get into China trade was probably last year when all the sell side or people on CNBC, Bloomberg just like trash talking China, like retail exits, institutional exits. That was the best because that was a peak sentiment. Sentiment in terms of like pessimism. But now, that was the real alpha generation opportunity. Now it's different environment. It will take more than sentiment driven opportunity. You have to dive deeper to the model, like what you said, and trying to see if you can generate some alpha.
Yep, good
Hey,
stuff.
quick
Let's
quick
see.
question.
Yeah, go ahead, man.
Quick question. It's regarding Alibaba. Do you know what the potential value uh, Alibaba is? If you take all the components that is trying to break up, if you value them also separately, do you know what the value market cap will be by any chance?
Um, Off the top of my head, I don't know what the sum of the parts says for Alibaba. Steve, I don't know if you know it well enough, or Chris.
But the sum of the parts,
I mean, at this
but it's
price,
consensus. It's consensus. The sum of
Alibaba
the parts
owns
will be greater, though, right?
several platforms. Um, I saw a post that reminded me yesterday. Xianyu, which is like a secondhand platform. It's a platform where you buy and sell secondhand goods, has over 500 million users in China, and Alibaba owns that, and that's just like one of the smaller ones. They have travel services. They have, they own 33% of Ant Financial, right, which is worth a whole lot. Of course, there are, regulatory risks with that, and the government doesn't really want, has a lot of restrictions, right, with the financial situation in China. But, there's Cainiao, which is the logistics division, Alibaba.com, Tmall / Taobao, which is like the retail app marketplace, which brings in a lot of money. Alibaba Cloud, right? Alibaba Cloud. And then they also own like a Turkish company. And then I think they have some investments in Indonesia. So, yeah, like I don't know exactly how they would distribute this to ADR holders. If anybody else has experience with this,
I'm looking at an
much
analysis
appreciated.
from April from someone who'd done the sum of the parts, and his analysis is that this is somebody who is valuing the whole thing today at 383. They're valuing the sum of the parts post all of the splits at 530. So we're talking about them seeing almost 40% value unlock in their world. But it's a pretty simple analysis. They're just using a price to sales multiple for each of their respective businesses. And the bulk of the value, though, is from the commerce platform and the cloud. And these other businesses have tens of billions of value, but those are the two big ones, at least in that person's analysis.
Yeah, I think price to sales is probably a problematic approach because, especially Alibaba Cloud, their margins are razor thin. There's mid to low single digits for that, and there's no indicator that those are going to grow anytime soon. They'll still grow in the top line. So yeah, I don't know if that's a really good approach. For
Hey, I got another
going
question.
by price to sales.
I got one more question. Do you think since the S&P finished above 4,200 that could be considered bullish?
I'm not really a technical trader, so I don't have anything insightful to say.
Yeah, like Tencent spun off their investment in Meituan. I think I mentioned this in an earlier Wook interview call that we had. I got that one in my account, and I have the Hong Kong shares of Tencent, right? So I got the Hong Kong shares of Meituan. But like, for example, if Alibaba spun off one of its investments, in some other company that wasn't listed in the U.S., like how would shareholders realize that value? Is my question. It's like what are the like logistical challenges given the situation with the ADR and stuff? Do you think that's a problem?
That's a great point. I haven't considered that. Are you going to get a company listed in Hong Kong? You're going to get some shares. Yeah, that's a real logistical question that I haven't seen answered.
Yeah, like most U.S. investors can't hold Hong Kong securities. They have their brokerages are just not set up for multi-currency accounts. So I guess they could get like a unsponsored ADR. Maybe they open up one of those for each of the companies. That's possible, but it would not be very liquid at all for these smaller investments for these spun off companies. So like, would a shareholder even want that? Maybe not.
Yeah, just going back to the last technical kind of related question. I mean, 4,200. It's we're back at a forward PE that's in the 18.5 area for the S&P 500. So with rates where they are, with earnings growth where it's expected to be, it feels like an extraordinarily rich market to me. But that doesn't matter right now. This AI FOMO could absolutely send things far further. I just have no insight though. The big mega caps are trading at add another 10 to the forward PE of the whole S&P. We're talking levels that haven't been seen since kind of the COVID mania, and there's no reason why that couldn't continue.
So I don't have a model on Alibaba, but we're talking about spending a lot of value, you need to look at one of the biggest contributors. That will probably be the Alibaba Cloud, and I think that itself you can easily get to a 200 billion just as a sum apart and just that alone. But it will be a 6-part sum, right? So that will be like the e-commerce group, TML, and then the local service group, and this logistic group, and then the domestic, the global commerce group that's different from their domestic one. And there's the entertainment group, and then you also have the and financial type integration as well. I mean, you're gonna have to dive into whatever to sum apart you want to get in, because their EBITDA by segment growth rate is kind of been declining for the past couple quarters. But if you project out in 5 years, I mean, obviously you can resume a relatively stable growth rate, but that's another question. And then in terms of your question, and then you're talking about the S&P. I think it's interesting if you look at one thing. I think it's interesting to look at is, I don't know if anybody pay attention to the U.S. dollars and then the 10-year yield. It just been going up. They're just been surging for the past couple weeks. 10 years almost 4%. I mean, not yet, but it's just how crazy the move is. It's a big deviation move, and then compared to how the Nasdaq's moving, I think that's interesting.
All right.
Hey,
Well,
how high? Quick question to you. Hey, how high do you think the market could go if it's detached from fundamentals?
I think it's already detached from fundamentals, and it could make all-time highs.
Sky is the limit.
I don't think it does, but anything is possible.
You should read what's his name? Stanley Druckenmiller's 2020 memo, and then you will know how rational people will behave when the irrational behavior triggers.
Hey, would you buy some long options on Alibaba, like 200 strike price?
Wow, that's out of the money. I was mentioning it just earlier this week that I thought Alibaba was looking interesting. I would not I would not go that far out of the money. I have not looked at the chain in terms of what's priced, but yeah, that seems way far out of the money for a stock trading at $81.
Yeah, well, when Meta was like trading 80, like I did the same thing. Like when Meta was trading 80, I did the same thing, and NVIDIA, like because and that's what I did in 2020 also. When they went real low, like and they had no rational.
Yeah, I think I'm looking
there's
at
no
the
rational
valuation. I think
reasoning
BlackRock
behind
said
it.
back in August, when we had August of last year, we had a lot of pessimism. They said 70 to 150 billion for financials valuation. BABA has a third of that. I think they have a 33% stake. So that's like like what, like 25 to 50 billion just for the financial stake. I think that's one of the biggest parts. And the Alibaba Cloud business, I haven't looked in detail at the Alibaba Cloud numbers, but I know their margins are pretty low, and their growth has been okay, but nothing stellar. The thing about China is that for a lot of the government, and state-owned companies, they go with Huawei for their cloud systems. So Alibaba, Ali Cloud usually is more for like startups and non sensitive sort of industries, non-government operations. So there's a limit to their market share, I'm sure, given the staggering growth of Huawei over the last few years.
I guess the other thing would be timing of these transactions. From media reporting, it does look like they're moving at a pretty brisk clip. So I'm looking at the chain now. If you wanted to have what I consider a pretty short dated call to Jan 24 is kind of close as I think about it. I know for some people that's a leap, but you could buy the 120 strike, which has about 20,000 open interest on that. The delta is 20, so you're going to get some really nice lift. If it moved up that 50%, right, you're going to get a pretty fantastic return. Those are trading at 275 with about a 44% implied vol. So that actually doesn't feel that expensive considering what's going on with them. But I would do more work on it before I got comfortable buying any Alibaba. And obviously there's the long lingering question we're clearly bringing up in this conversation of how do you actually get the cash distributed to you as the shareholder. Now, if you're just long the options, then you probably don't need to worry about that anyway. Because
I mean, how are NVIDIA investors going to get their cash from their investment? I mean, how does
selling it to somebody who pays more?
Exactly, right?
I agree. I think that most people are betting on greater fools right now.
I mean, I think
buyers.
don't forget one of your favorite investors, Ryan Cohen, is holding an Alibaba. He has position. Michael Burry has a position in Alibaba. I think a lot of interesting, money managers have sizable positions in Baba.
I mean, to what Lashman said, it does on its face kind of look like a bit like a Meta, that it's very much beaten down, but there does seem like a pretty severe discount. But who knows, right? If you're anytime you're trading options, you're taking on then a lot more risk.
And
what do you think about JD?
What you said about TSM, right? With Taiwan Semi, they make the chips for NVIDIA, and they have the best yield of any fab. So they put out the best semiconductors. So, but they trade at 18 times earnings, but like NVIDIA is at like hundreds of times earnings. So, the whole China situation is, people don't want to have exposure, but I mean, I think any stock really has exposure if Taiwan situation gets, crazy. Like if there's a real war, right, that people are, worried about, I don't think you're safe anywhere, really, unless you have, treasury bills maybe, or gold.
Or you've put hedges on your individual securities with that exposure, right? Which then is obviously a cost of carrying those and yada yada.
So I think it's irrational. I think people, you can't expect them to behave 100% rationally. And people prefer American stocks, right? There's a lot of liquidity in New York, right? New York Stock Exchange. People can hold all these stocks in their account with Baba, right? Like I said, it's really uncertain how you're going to realize all this value, and if it's like a value type play, right? If it's a value investment, you're really relying on the heavy lifting being done by the, some of the parts, and the spinning off of all these entities. Whereas like with NVIDIA, right, you have all these funds just pouring into this and media coverage and all this stuff. With a lot of these Chinese names, you have to do a lot of research to know what these businesses really are, right? And, how big they really are. Because I think a lot of Americans just don't see the scale that exists in China and how big these. Of course, the margins there are smaller, right? So you have to discount it, but.
And the state could simply come in and say, this is no longer a for-profit segment of our economy, like it did with EdTech, right?
Yeah, I mean the educational industry. I think some of those stocks are still in existence. They're not gone, but I mean, yeah, their valuations are way below those stratospheric ones we saw in 2020, 2021. Like was it Gaotu, GSX?
Yeah, that was a
they
Bill Hwang
changed their
special.
ticker. Oh my God, they changed their ticker right at the top. It was so sketchy. That one was a scam. It was scammy, but yeah, that doesn't bode well for people who want to invest in China. They see these stocks that they have fake teachers, right? Like that, and if you're an American, right, you're like, I don't know what's going on there. I don't want to invest here, and that's totally understandable. I don't blame anybody for not wanting to invest in China. Because the average person doesn't really know what's going on. But I think there's some great companies there. Alibaba is not a shitco. They have a huge business. They own many huge segments in China, and I don't see the government taking out all of them, making them nonprofits. I don't see that as a realistic expectation. But in terms of profit margins, like with like software and these services and stuff, there's a limit, right? If you're gouging customers, like the government's not going to like that. So like with the software industry in China, like you can't have a situation where companies just has virtual monopoly on some of these things.
Good stuff, Chris. Okay, it's 10 to the top of the hour, though, so I'm going to wrap it up here and let folks get on with their weekend. Appreciate everybody, Chris, Steve, last ones, and I know that Paul jumped away, but everybody who came up and chimed in on the speaker panel, thank you very much, gentlemen. Appreciate it. We'll be back next Friday with our weekend review call, our Wook review at the close. We'll be back also on Tuesday night. I have it pinned here. Our One Up on Wall Street book club discussion at 8 o'clock Eastern. And we'll have our open mic on Wednesday as well, which I had a family emergency to attend to, so I had to skip it this Wednesday. But on my personal account, we'll be back Wednesday at 7. So I look forward to catching some of you next week during some of those programs. Have a nice Memorial Day weekend, everybody. And we will talk soon. Stay safe out there. Cheers.